commercial property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
Good everyone, how you going? It's Phil Tarrant here, co-host of Inside Commercial Property. We're back by popular demand. Huge milestone issue, episode. Season 2, we're kicking it off, episode 1, and we're live. I'm here with Scott O'Neill. He's director at Rethink Investing, and we're also on the interweb. We're on the YouTube. We're filming now. One of the big changes for this season of Inside Commercial Property is that we're now going to be videoing it so you can see warts and all what we look like. I've got to remind myself now not to pick my nose, Scott.
Thank God.
Oh no, I've got to dress a little bit better. I didn't really work that out today. I'm so look like a bit of a hoodlum, but I'm wearing the Momentum Media kit, which is all very good. But who would have thought we'd get into season 2?
I know, it's come out of nowhere, hasn't it? Little COVID creation, and here we are.
Well, there's 2 great creations I've had through COVID. One was that I ended up with a baby as a result of COVID-19, the old COVID lockdown, and well, I don't know whether I'd put launching the Inside Commercial Property on the same, but it's been a good one, mate. No, baby 100% better, but no, it's good, mate. I really enjoy it. How's the world treating you?
Yeah, it's good. Yeah, like couple of weeks away on the Gold Coast, so finally got over the border. I think we had 3 trips planned before actually getting there because we kept getting shut down after it. So had a bit of a break, bit of a little surf trip there. It was good time. So just back working and doing the podcast with you now.
Did you look at any properties while you're up in the Gold Coast? You can't help yourself?
Oh, one day I did a big lap around Brisbane, checked it out about 5. So there's got to do a little bit while you're there, but going to head up a couple of times more, I think, because now it looks a little bit more free. So while the borders are open, get into it.
So what's the word on the street up in the Goldie and Brizzy for commercial property? You're sort of, unlike residential property, you don't get to drive through a street and see all the sort of open for inspection or for lease or for sale signs with no sold stickers on it. It's harder to get a read on the market, but no doubt you sort of had to drive through the industrial areas or the office-based areas. What's the feel for you, mate?
So it's very tight. There's not much for sale. It's not many signs up. There's some areas of weakness. Like you can see the Goldies had a bit of a hit from, I guess, the lack of tourism. But, like we went out some of the nights, I've never seen it busier. And I used to work in the nightclubs there on Orchard Avenue near
Cavill. Did you?
Yeah.
When was that?
A long time ago.
Are you from the Goldie?
No, but I lived there for a summer. So
you did your stint up there in your 20s?
Yeah. So I just worked at nights till about 4 or 5 a.m. and then you'd, go straight there to the surf if you could or sleep till, 1 o'clock in the day. So... it was crazy times back there, but it looked the same. It was. I don't know. I was actually surprised how busy, but in the day it was dead. Yeah, it was. Maybe there was an event the night we were sort of in there, but I don't know. It's a very funny town. Like there's a lot of the sort of weaker retail strip shops that you can see have gone under. There's like that Chinese duty free shop that there's a big famous vacancy there. There's I don't know, the rail line's done some good things for certain areas. Food seems to be going okay. But it's a hit and miss town. Brisbane's just feels like a big city these days. It's all going, strongly there.
So just thinking of the Gold Coast, we'll have a quick chat about Brizzy and it's sort of a bit off topic, but seeing that you've been out there looking at stuff, I'm actually heading up to Brisbane myself in about 2 hours' time. So I'll make my own assessments. I'll make my own assessments when I get up there. But for the Goldie, everyone always talks about the impact of COVID-19 on residential property prices. Now this is focusing keenly on inside commercial property. And we launched this during COVID-19 to give some sense for what was going on. Back when no one wanted to touch commercial property, everyone thought that the bottom was going to fall out of the office space market, hence one of the catalysts for us to get going with this. But Goldie, it's such a tourism town. So your retail and connected in with that also would be your office type markets. They must have copped it pretty hard because you've got no international tourists going in there.
Yeah, look, I guess we didn't really look at any of the office up there, but there's plenty of vacancies. I think last stats I checked, 1 in 6 Perth offices were vacant at the moment, so very high numbers. And Goldie wouldn't be that bad, but yeah, look, it's a market that has retracted a fair bit. But interesting, like I was talking to you before, we're looking for a new office for Rethink because we've got a few extra people and we need space, and I can't find one. We've been looking for about 6 months. There's plenty out there, but they're dingy offices, or they're they're pokey kind of south-facing things with in an old building. Like there's a lot of that stuff, but a good quality office property, there's just not much out there. So good qualities are just getting all taken up. They're absorbed, and we're finding it firsthand in so-called a weak market, which is office. There's just not a great deal out there.
Do you think the challenge with that is, and again, a little bit off topic, but connected for our viewers and our listeners on insidecommercialproperty.com.au, Inside Commercial Property, that because a lot of organisations now provide some capacity for work from home or some sort of fluid or hybrid working environment, they don't need such large premises. Therefore, that sort of smaller to medium-sized stuff is a lot harder to get a hold of because there's a lot more demand for it. Do you reckon that's what you're seeing right now?
Yeah, and look, there's a new take-up of people getting back into the office. I think we've hit – it pretty much started at the start of this year. I felt like a lot of businesses deliberately held off going into offices in 2020 and then put their decisions after, something to revisit after the Christmas holidays. And we saw the vacancies tighten in certain areas. Like, I'm not talking CBDs either. We're looking for an office around sort of Bondi Junction type area, like just out of the CBD, and it's tight. And but the CBDs, same deal. Like if it's a good property, there is action on them. I know the sales side of things, they're going for record prices still per square metre for vacant stock. So that's cheap interest rates more than anything. Yeah. And there's people going for the long-term hold, not worrying about the short-term risk of leasing.
Okay, interesting. It's always good to get a bit of a situational awareness update when you are travelling around Australia doing what you're doing, and I'll be happy to report back my sentiments and views towards Brisbane moving forward. But it's great, everyone, to join us as we kick off Season 2, Episode 1 of Inside Commercial Property, and we're all obviously on the Smart Property Investment YouTube channel. You go and track us down if you want to actually watch this, and you can see how we go about doing this. You'll see rivers of paper and preparation for each of these chats, but it's good for everyone to sort of actually go behind the scenes and see how we go about recording these particular podcasts. They are pretty fluid. They're freestyle. We know what we're going to talk about, but we don't necessarily know how we're going to get there. So that's why we like to run it. And it's also really organic and authentic, and allows us some people to write in and have a chat. So we've got some questions today. There's a really good one here in particular, which I've plucked out from Danielle M, that we'll get into. But there's a whole bunch of other information on smartpropertyinvestment.com.au around Inside Commercial Property. Go and check it out. You just click on the podcast tab and you can make sure you can check it all out. Any questions at all, you can also do that through smartpropertyinvestment.com.au. You can send a question to our team here, editor at smartpropertyinvestment.com. Now, as we set up for Season 2, Scott, so this is our 13th episode, so the first one. We're going to get some guest stars into the studio and have a chat to us about their journey investing through commercial property. And, the last chat we had, the back end of Season 1, we sort of really got stuck into the realities of commercial investing in this particular market and how commercial property is probably not right for everyone. How did that go down with our listeners?
Yeah, look, really good. And off the back of that, a lot of people were asking, well, what types of yield should you be expecting? So we should go through, the yields we're seeing out there. Some of the mistakes we're seeing others make, because there's a lot of them. There's that fear of missing out theme is hot and heavy at the moment, and it's not letting up. There's people out there, just because the bank's lent them money, they're determined to spend it, and then they get attracted to a certain property for the tenant or whatever, and they can overpay by 50%. They don't even know what they're doing.
So that's bonkers. This is the reason why we kicked off this podcast, so people don't overpay by 50% for commercial. Now, look, the argument is that whatever someone pays for a commercial property is what it's worth, right? Yep. But it's whether there is inherent value in that valuation. And if you're paying 50% over to your to where you would market, that's one view of it, whereas other people are probably thinking they're getting a great deal. So we'll kick that into today. I've asked you to sort of work up some case studies for us as well about what sort of stuff you can be and should be buying right now. And a little birdie told me, and there's, it depends how you want to view this, but and whether you subscribe to this or not, Scott, that there are only ever really probably about 100 really good commercial properties for sale in Australia at any given time. Now, I'm going to pick that up and use that as our theme for this particular podcast. You're talking about people paying 50% over what you deem to be the value of a property. Is there more than 100 really good properties out there on the market for commercial at any given time, or do you reckon that's a pretty fair – where this come from, I don't know, but I'm hearing it getting bandied around, and I'm not going to own it, but I'm happy for you to own it if you want it.
Oh, look, it's hard to quantify it, but look, we've got the capacity, and it's not hard because there's not that many that get listed, but we can look at every single listing in Australia commercial-wise, even just through the channels. There's obviously a lot of off-market stuff, so you don't know how much stuff is really going on, but I know online there's not that much out there because they're either overpriced, there's a weakness in the lease, or there's a reason they're selling, like maybe the tenant's about to leave, or it's a vacant property. There's plenty of vacant stuff for sale. So a good tenanted investment at the right yield, sure, I'd buy into that type of number. Because you got to fight hard for it. So there isn't much out there. It's a much smaller market than residential, and that's where I guess our job is very connection based. Like we know agents, and without that, we would not get through the day by any way. Like because you can't just compete online and expect to regularly buy good properties. It's just not enough out there. So, there's not much out there. And then why? Like, I guess the reason is why would you sell? Interest rates are low. Where are you going to park your money? It's into the residential market. You look sure if you've, but the yields are so low. Like if some of the markets are more mature in their growth phase, so that maybe there's not as much left. So commercial does represent a really good return on your money. So. You're generally picking off a good deal from a developer who's about to cash in to do a big development, or maybe there's a guy in their 80s who the kids don't want their property. There's a bit of I guess there's not that many circumstances where you can get a good property which has no hairs on it, and that's the trouble. That's where we've got to find
we
it.
spoke through season 1 of Inside Commercial Property about those properties with hairs on it, and we sort of worked out that nearly every property has some hairs on it, but some properties have more than others, right? So it's really uncovering what is the cleanest, clearest, most transparent property or asset to purchase, and how that fits within your portfolio. Now, if there's only ever really 100 good commercial properties for sale at any given time, right? There'd be one argument to say, well, we're just propagating people making poor investment decisions because we're getting thousands and thousands of people now tuning into this particular podcast going, hey, I'm going to invest in commercial properties. So are we actually doing a disservice to the community by talking about this, or are we doing a service to the community by helping educate them to probably not buy commercial property or only buy those which are really the diamond?
Yeah, look, definitely both. Yeah, because you can tell there's just so much competition, and it like you said, there's thousands of people that listen to this, and even if 1 in 100 go out and get a bit complacent and overpay a property, I don't know. It's just a numbers game. It simply will happen, And then on the other side, we're helping people invest in a lot of properties, and we can go through a few examples and stuff like that because that's what people mentioned they wanted to hear. But look, you got to be careful in this space. You can lose money in commercial, and that's the whole. We're not here just to spruik it. It's a way of losing money if you don't know what you're doing, and there are protections, and we can go through that. But look, this market has got legs in it. You don't need to rush out and buy in the next month or two. And we're dealing with a lot of clients trying to tell them that weekly because we don't want to force a property. We're not here just to give them a property because they want one. It's got to be the right one at the right price. And unfortunately, that might mean there's a waiting list, and that's what we're working with. Unfortunately,
which is hard for you because. You do a podcast like this and all the other work that you're doing, you're setting expectations for people that, okay, you might want to buy a commercial property today, you might be finance ready and you're ready to go. That doesn't mean it's still the right time for you to buy. to your point around the speed of market, it's grown considerably over this last period of time. Whether there is much steam left in this market or where those markets are, I guess that's up to you to work those type of things out. But how do you get this message of just slow down and don't rush into this stuff? Because if you do rush into it, or if you're coerced because of whatever reason to buy property quickly, that is when you don't necessarily make the best investment. So the real word on the street for property investors, just take your time.
Yeah.
Take it easy.
It's a long-term game, invest for the next 20 years, not for the next 3 months. And look, I'll use some examples.
Yeah, let's do this. How many examples you got for us, Scott? We'll go through them.
We'll start with 3, and if we need more, we'll go.
All right, so 3 examples. So these are the sort of stuff that represents good value, or what you deem to be good value, good buying, smart buying in this current market. This current market, not 6 months ago or a year ago. You're talking about deals that have happened recently, right? And
I'll use a bad example in the same suburb or adjacent suburb. So I've got to be careful. I'm not going to say exact suburbs or...
You can just give us a region and the type of asset.
Because otherwise the bad asset agent will come try sue me probably. So.
Yeah, probably. Okay.
So, all right, this one we bought a couple months ago. So it was a day surgery. It's around Sunshine Coast area.
Okay.
So we bought this, it's circa 2 mil purchase price, which represents just under an 8% net yield. There was a 3-year lease, long-term tenant, personal director guarantees, good, solid investment, freestanding asset. That was an 8% net yield. Now, 2 weeks ago, in the same suburb, a vet came up for sale. We liked it. We go, all right, we put a 6.5 net yield offer on it. Someone bought it at less than 4.3, so 4.2. It's a ridiculous decision. No, that had a shortish lease. There's definitely risk on it, but this is the key. People thought, oh, look, it's a vet. That's great. Now what they've done is killed their growth off for the next 5 years at least. What's the point of that? They've got very low cash flow. If interest rates go up, they're sitting at a very Sydney-like level in a regional area. And it's just... that kind of stuff is going on. So when you're overpaying by 50%, that yield should have been probably 7 in a real world. We got in the same area on an 8.
So okay. Why is that a bad deal? You're talking about it from a yield level. So you haven't even talked about what the price of the property was, but largely irrelevant because it's the outcome of the cash it generates, right?
High ones for that one. And so it's a bad deal because, number one, if you were financing it, there's no chance he'll value that at a 4% yield. He'll value it at probably a 7. So you're going to have to dip in a lot of cash because the bank's not going to lend up to the purchase price. They'll say, look, it's not a $1.8 million value. It's probably a 1.4. So you're going to have to throw in an extra $400,000 cash just to get the deal over the line. If that's a good thing to do, why didn't you use that extra $400,000 to leverage up and buy a $3 million property? Instead of buying a 1.8, so you can stretch your money further into another asset, get more cash flow. So it's about getting return on your equity.
So do they overpay for the property, or the mechanics of the lease structure undermines the economics of the purchase?
So they overpaid. So the cap rate for the area, call it 7%. And they've gone in an area where you should normally be expecting a yield of about 7. They've got a 4.3.
Okay. So let's talk about yield. So yield is how much money it generates through rental payments or the lease versus the value of the property. Really simple equation.
So if you're collecting $70,000 income on a 7% cap rate, that's $1 million property. So someone's gone and said, oh, look, 43 grand is worth $1 million. So that's like going into a Sydney property market where the average house for a 4-bedroom is $2 million and someone just paid $3 million for no other reason.
Yeah.
It's the exact same thing. Would you do that in residential? No, you'd be mad too. So it's the same thing.
Yeah.
They just haven't put 2 and 2 together. They've viewed the strength of a vet type tenant so well that they've gone nuts for it. So
do you reckon there was some preconceived bias there going, oh, it's a vet and it's an area where there's lots of dogs and cats and therefore they're going to stay in business. It's going to be COVID safe because even if there's COVID, animals still need to get their stuff fixed up. So do you reckon it's just a less sophisticated investor has gone about doing this, or you've just got a very good salesperson?
Oh, look, like it's probably like you said, it's the safety factor of it. So this happens a lot in all those auctions where, we talked about them last week or last month rather, where there's childcares and stuff with big long leases. Fuel stations come into that. I don't know how they still kind of come into that radar, but long leases, they're attractive to certain people and they'll take a hit on the yield. And maybe it's the frustration thing, like where else do you buy these properties? Like, they're readily available through an auction campaign, so you can see it, you can actually buy them. So it's more accessible to people. So, yeah, look, it's I think it's a lack of education thing, but look, 4.3%. I'm always looking at a return on money. Like, if you've got more money to burn and it's just parking money up, then good luck to you. That's a different story. But those types of people generally aren't playing around in the sub 2 mil range anyway. They're in a higher level as well. And if you're looking just to do that, why don't you just put your money in a managed fund and park it up that way? I don't know. You're not dealing with a small tenant at the end of the day. So, a bit of craziness. So, that's a very recent example of two very similar properties and one is literally half the price of the other.
So there's winners and losers, I guess, in every property transaction. What you would like there to be is that there should be win-win-win. So the vendor wins, the agent wins, and the new purchaser is a winner. Yeah. But sometimes that's not always the case, right? So these two deals, tale of two cities, tale of two deals. Why is the deal that you guys manufactured and settled on better than the other deal? Is that because you didn't pay over for the actual property?
Yeah.
And that's the key thing, because the lease, you can sort of fix it over time, but if you pay over on the way in, you're never going to fix a crappy property, right, through leveraging up the lease.
Yeah, so like you got to know the cap rate of the area. If you don't know that, you shouldn't be buying the property.
So what's a cap rate? Let's talk about that just quickly.
Capitalisation rate.
Okay.
So it's a valuation method for commercial. So you got to understand, like if you're buying an industrial property in Sydney, you got to go, well, what are all the average yields for a similar 3-year lease? They've got different sort of price guides too. If you're buying over $5 million versus a $1 million one, there's going to be slightly different yield. So it's the same with residential. You've got to have a comparable sales analysis.
Yeah.
You have to do it with commercial, but cap rate's the easiest and quickest way of valuing a property, I find. So it's like for us, I guess we're always in the market, so we kind of know exactly what it should be because we're the ones buying so regularly in these markets. So it's a bit easier because there's no good source for manual data on this either. The way to value is kind of speak with agents, look on RP data or what's the other one, the price finder, and find out what others have sold for and then what they rent.
It's CoreLogic RP data. Get annoyed being called RP data these days. CoreLogic.
There you go. So yeah, it's just manually picking all those numbers out of the systems and go, all right, well, a $2 million warehouse should be selling at a 6% cap rate. So that means you should be getting 120 grand for a $2 million property. If you're getting 90 and you're paying 2 million in that same market, you're ripping yourself off. So if you don't understand the cap rate, just hold off on the offer, I think, because there's just no point throwing that type of money away because, in that quick example, you might be overpaying by 400 grand.
Yeah. And how do you actually know what the end product was that people bought this for? Where do you get that intel from?
Look, the agents tell us as well. So, and look, again, like we've got a little bit of an unfair advantage with agents. Like it's funny, one of our competitors is, they know we sort of don't like going under 6. So they've gone around all over Brisbane and southeast Queensland going, I'm going to pay 5.5 net yields. And all the agents are taking little screenshots of it saying, haha, look at this person, because it's...
Would I know who they are?
No, we're not going to mention. But
no, would I know?
No,
maybe not. No, okay. All
no,
right,
but there's a little bit of that competitiveness out there with the marketplace. So
5.5 is still okay.
Yeah, but and this is where it can get a bit murky. Even if you offer 5.5, if it's below the cap rate and you've got a buyer lined up and you paid that, a valuer will come in and say, no, look, I'm looking at this market as a 6.25 cap rate.
Yeah.
So now I'm going to short value because it's all subject
to... So they
to
still lend you the money based on what they deem the valuation to be, and therefore you just got to pay the gap.
Yeah, and most buyers don't want to. So they'll crash the deal. So it's good for the agent to get a market purchase price. Every now and then you get a cash buyer who's willing to
Go overs a bit.
Yeah. And that's good luck to them if that's what they're doing. But agents would prefer an on-market qualified buyer who's paying the right money from the start, because then there's less chance there'll be something wrong go in the back end of the transaction. So
yeah, that probably doesn't help the agent to, if you go too far over the basic equilibrium where the market is, you set an expectation that you'll never ever receive it or get it again, right? It becomes a negative self-fulfilling prophecy for the agent if they get sort of these anomaly deals, because that's what people want then.
Yeah.
Makes life hard. Yeah,
exactly. So everyone wants an on-market offer. If it's slightly over, that's fine. Like the value hopefully won't punish you too much for a good lease or something like that. But look, it's about sort of paying the right amount. When you sort of miss the mark a lot, which there's been more and more of these cases because it's just low stock. Everyone's kind of excited. That's when you see these crazy numbers get thrown out.
All right. Now, let's do another example. What do you got for us, Scott?
So this one is in Brisbane, so off-market transaction. So it's a classic warehouse. Put this one on Facebook, so you'll be able to see it on Rethink Investing's Facebook page. It's just a classic warehouse, roller door, 5x5 year lease to a national business. It's about, 10 Ks out, 14 Ks out, sorry. And 6.25 net yield. So this is a market which is compressing quickly. So we're seeing frustrated buyers go into the 5% in this market. So 6.5, even 7 still exist in Brisbane. So if you get excited, don't just go rush and buy something at 5.5, because if you wait an extra month or two, you might get stuff into the 6. And you might go, what's that 0.5% difference in price really matter? And it matters a lot. It could be 200-300 grand. And, for most people, that could take half a lifetime to save. So you can lose it in a blip if you just misread the market with commercial. So again, work out what the cap rate is. The cap rate for Brisbane is around that 6%, 6.25. For super prime assets, it's lower. That's your, $10 to $50 million type stock. That can be lower, but there's normally a large freehold land component for that. So there's potentially development upsides for those 5%ers. So it's about making sure your yield's high. And look, that's a good market for growth, I think, because Sydney is still into the 3s and 4s. So relatively, there's value there. But if you go out and buy it at 5, you've lost your value straight up. You may as well have just stuck in Sydney or Melbourne and playing the long-term game there.
And Brizzy markets. What are you liking up there at the moment in terms of the commercial stock? Is this warehouse stuff pretty popular for you?
Yeah, the leasing
logistics stuff. Yeah,
leasing market's hot. So there's a lot of tenants, new businesses, growing businesses. Like a lot of businesses where they've got a warehouse and they need an overflow shed because their capacity's just grown, and they're like, what do we do? We've got to lease another shed out. So like vacancy rates are dropped. We're down to sort of 2-3%, which is good for industrial, because normally you'd probably be double that. And we're seeing leasing rates go up. Incentives. So an incentive is, let's say you get a 5-year lease, you might offer them 3 or 5 months free rent, just as a thank you for coming in, and here's some help doing your fit out, whatever it is. Incentives are dropping as well because there's more competition. It's just supply demand. There's not much supply of a well-located warehouse, flood-free, good quality one. That comes, that's available in the market. And interestingly, with this one we bought off market in Brisbane, it came up registered as a flood zone. And this is a little bit of a tip with due diligence. Not all flood zone properties are flood. So the bank said, no, we're not going to lend on it. So we said, well, the flood map's wrong. You should, it's never flooded. We pushed back on the bank, and we worked out how to do it properly. We actually got a surveyor out and did RL height measures on the site, proved the zoning on the map was incorrect. The bank accepted it, and it removed, it's still zoned that, but it's not a flood property at all. And the bank was happy with that.
It might flood around it, but it won't flood it.
Yeah, because a lot of the Brisbane maps are actually artificially, they've put a 1 metre factor of safety on it as well. So, a metre more than it ever flooded in 2011 can actually wipe out a lot of areas, which probably will never flood again.
Yeah, well, there you go. So you keep talking about sort of gross return, Scott, and let's just quickly touch that. For some people, they know what that is, but for our new to commercial property investors, what does that mean?
So gross return is, there's two types of leases: net leases and gross leases. So a gross lease is when they, like, let's say they pay $200,000 a year, but then you have to pay all the outgoings. You might have 40,000 of outgoings out of it. That can include rental management, maintenance, rates, land tax, all of that. A net return might only pay $160,000 income, but then they pay all those outgoings. So the overall position's the same. You always work off your net figure, but a gross lease, you've just got to pay the bills yourself and factor those costs in your equations.
Okay, so a gross lease means that you may generate more income from the property, however you incur more of the costs, whereas a net lease is that you receive less income, but you incur less of the costs. So at the end of the day, it's the net return is what you want, and that's how much money is in your back pocket after all expenses happen, including mortgage repayments.
So it's sort of overall, it's the same thing if you calculate it back to net. Sometimes gross can be better because if you've got a 4% increase per annum, it's better to have 4% on a higher gross figure. 4% on 200,000 is better than 4% on 160,000. So your rent might rise, but I guess the negative side of a gross lease is the cost can be more variable. So maintenance might be up or below $5,000 difference each year. So
if you talk about a 6% net return, so that's 6% on the annual rent or the value of the property.
So 6%. So if you've got a $2 million property, it's 120,000 net income
in your back pocket.
Clear. And out of that, you've also got your mortgage potentially. But then you've got a depreciation benefit. So one of the great things about commercial is you get to claim the full depreciation on plant and equipment. So it's not just the building. You can claim, air cons, you can claim the previous landlord's renovations if there are any, all that stuff. And there's a lot of...
So you can depreciate someone else's fit out? Okay. So you've essentially acquired that fit out as part of the purchase, and therefore you get the upside benefit of depreciation, which is very different to residential property, which changed in the 2016 budget, where they said you can't depreciate existing plant and equipment anymore.
And one of the other good things about commercial is a lot of the value is there's more floor space in the value. So like, how do I explain that? Let's say you've got a shop front, it's 200 square meters. Like you've got 200 square meters of actual building and walls and high-end fit out. So there's a lot of depreciation in that 200. Imagine you've got a 200 square meter house on an 800 square meter block. You're not depreciating on the land. There's more value in the land for residential. And so your depreciation benefit's a lot less. So it's actually quite a tax-effective strategy, commercial, if you get it right, especially if you buy newer products too. You're not paying much tax on it.
Yeah. That's good. I don't know too many investors that love paying tax. They're happy to pay their fair share of tax to keep this great nation moving ahead, but they just want to pay their fair share. Okay, let's do. We've got time, Scott, for one more example. What do you got for us, mate?
So this is sort of on the higher end. So we love neighbourhood shopping centres, as we've mentioned a few times. They've come out of COVID surprisingly good. So these are, where you got your small supermarkets and basically
fish and chip shop, bottle shop,
a variety of good shops.
Medical centre,
just bread and butter stuff. And it normally comes with lots of car parks, a couple of medical properties. So we got this one in Perth. It was 9.25 mil, 759,000 net income. Had a good little supermarket and a whole variety of shops. There was basically 15 odd shops in it. So we're looking.
It's a big price point, 9 mil.
Yeah, so it was about an 8.2 net yield. So in these areas, there was the cap rate was about 7%.
Okay.
So you can still go high price point. Yes.
Yeah.
Surprisingly, there's a fair few of these big dogs running around.
Who's buying this sort of stuff? Is it like
everyone it's business owners, developers.
Okay. So developers are like grabbing it and holding it for some time, and eventually they might do something, put a big thing on it and put a shopping centre
Well,
under it.
we're finding a lot of the developer margins are so weak at the moment. They've given up on development for now, so they're just parking it to get a return on money.
Okay.
And maybe there's a long-term development upside play. So, because I speak to many developers who have been just going crazy in Sydney for the last couple of decades. They just can't get a return on money. Like, you're buying at 0% margins, hoping for growth. Like, that's a crazy strategy.
So they're probably buying for the next generation. So they're getting ready for when someone else takes over the development business, they got some nice blocks that they can build on.
Exactly, and they collect a 7-8% return via cash flow every year as well.
It's not bad. For every $1 million they plug into it, they get a nice return off it.
Yeah. So these returns are still out there. They're harder to find, but like, again, the main message is just because you see a vet or something with a big sparkly 5 to 10 year lease on it, don't go throw the kitchen sink at it and cop a 4% yield. You don't need to. There's just patience. They're out there, and
so this thing here, so 15 individual tenancies inside it, $9 odd million. What else you got?
So otherwise, a lot of the stuff we do quite high volumes of warehouses, like in strata complex. So this is more your sub $1 million range. We kind of average about 6.25 to 6.5 net yields, maybe a 6% flat if it's a good strong lease. But this is good for your most everyday people. So $1 million, you can get in that with, you can do an 80% loan in some cases. So, $200,000 down, you're allow for stamp duty and whatnot. So another $50,000. So you're investing $250,000 to get, say, a $65,000 return. And if you get your calculator out,
Here we go.
Because if you've invested $250,000 and you're getting 65,000, that's a return of 26%. So it's not bad.
You can't complain.
So that's after that you've got a mortgage, and so you'll lose about $15,000 on your mortgage on that. So it's double-digit cash flow returns, and that's $250,000 invested. You might do a 70% mortgage. That'll slow the return a little bit. But the numbers are out there. That'll be capital city stuff. So
okay,
they're out there.
Good. Well, good examples. Now, Scott, we'll kick off with it's a new season of Inside Commercial Property, episode 1. A question, and we dug out a really good question we received a little earlier on from Danielle M. We'll call her. Thanks for writing in, Danielle M. You know who you are. Thanks for tuning into the podcast. Great that you're getting some value out of it. Danielle writes, "Hi Scott, congratulations on the book. This is this new book you've got. What is it called again?"
Rethink Property Investing.
Okay. Is it flying off the shelves? Is it?
Yeah,
You're in the second run, are you? Second edition, updated second edition.
I'm a bit surprised. We clicked over 10,000 copies sold. So
have you done 10,000 copies?
It's bloody. Yeah, I never would have thought, to be honest.
That puts in bestseller category, doesn't it? 10,000 copies.
It's. I think, like we said last time, we've got a pretty good reach in the market, and I think it's timed right. I'm definitely not taking credit. The market is very property hungry. Yeah, and that's what you need. So right place, right time, and it's a different book. It's about commercial. There's 500 out there about residential. Yeah. So if you want to grab a copy. Just go to Amazon or Booktopia is easiest, or bookshops.
So you can actually get it and hold it and read it like in your hands. It's just not a digital thing.
No, proper book.
All right. Available in all good book outlets. Go and check it out. You're going to give us some to give away on this podcast?
Yeah. Okay. I've got half a garage full of them. So
really?
Got to get rid of them.
All right. Well, I don't know if Danielle M has bought the book yet, but there's a copy coming your way. If you can just email, what's the best email address?
info@rethinkinvesting.com.au.
And then and I'm talking out of school here, but for those questions that we read out on the Inside Commercial Property podcast, I'm sure Scott will be happy to send you a book straight to you, and he'll even pay for the postage and handling.
Good idea.
Have to pay for that. Good on that. but look, seriously, if you want a copy, get in touch with Scott. So, hi Scott, congratulations on the book. I can't wait to read it. Well, there we go. It's coming your way, Daniel M. Don't buy it. It's one coming your way. I'll probably know the answer to my question below, but I have when I have, but in the meantime, can you please tell me how the value of the property works? Because the lease is longer than previous, i.e. 3 years, but at a slightly lower rent. Does this mean the overall value of the property is likely to be lower? Or is the growth on the property related to the growth of the suburb like residential? Now, two different bits here. So this is, most people frame commercial property, Scott, like residential property, as in you buy an asset in a good residential location and then you just sit and wait for it to go up in value. The same holds true in commercial property. You do get organic capital growth through property with the upside growth or development of a particular suburb or how that might change over time or all the other stuff connected with it. But the beautiful thing about commercial property is that you actually have different mechanics and different drivers for supporting growth in the valuation of your property very quickly if you buy well. And this is what Danielle's getting to right here. So if you do stuff with the lease, you can create value in a property pretty quickly. Yes, correct?
Yes.
Okay. How does that work?
All right. So you think about what an investor would look for in an investment. So what does everyone want? Long lease, good tenant, great area. So you can't really change the area. That's stuck. So the only things that'll change the area are long-term gentrification things or maybe infrastructure spends to speed up travel time or access, things like that. So you can't really change that yourself. Leases, you can. So we often at Rethink Investing help clients get into properties that have less desirable leases, like maybe 12 months or 18 months. Like we don't want that really. We want 5 years. So that's okay if you're getting a discount on it because you'll cop the extra risk of a shorter property lease and then position it to an investor at a 5-year lease once you renegotiate it. You might take 2 years to get that lease, but it will be a better property, better product to someone with a longer lease. And that someone might just be a valuer because you don't really want to sell it. You know, you're not buying this stuff to flip it. Like this just in Australia with too many taxes and, you know, it's too costly to get into property to flip, I think. It's better, you'll make more money long-term hold. But if you position it to a valuer with a longer lease, then they're going to say, look, it's a stronger asset. So that will increase the value. Obviously, increasing the rent increases the return. That's a way. So you might buy a property that's renting for 110 a square metre, but the market value might be 150. So there's uplift there. So this is all neat lease manipulations. And it's perfectly legal. It's perfectly, you just got to work with a tenant. And that's the tricky bit. So you might need to show spreadsheets of what everyone else is renting for in that area. And maybe it might be a slow process to get them to the market rent. So that's the way of kind of increasing value. Adding floor space, you might do internal mezzanine constructions because that obviously means you can charge per square metre. That increases the rent. You might have to do a little feasibility study to say, is it worth spending $100,000 on a internal mezzanine or office? But you might get $220,000 a year return on that. So that might be a 20% return on the build cash flow wise. So that could work. The cap rate, which we mentioned earlier, is definitely part of it. So cap rates are an area like right now we're seeing people paying more and more slowly for properties. And that means, the value is going up. That's like kind of your yield compression growth, which we're seeing a lot of at the moment. That'll keep happening until interest rates start rising. So yield compression is the free kick a lot of getting. But and the other way is actually improving the type of tenant. So we mentioned that vet example. If that was a kebab shop, they wouldn't have bought it at 4.3. They viewed it as a strong medical or essential service type tenant.
So you're saying kebab shops aren't as valuable as medical centres? I'd say kebab shops are more valuable.
Probably to some, yes.
Next door to any given pub, any given Friday and Saturday night, mate, you want to be in the kebab business. Yeah.
Agreed.
Digress. So there is ways to manufacture valuation uplifts or equity uplifts in commercial property, probably more than in resi. So it's similar principle in that you can buy a resi property and you can do something different to it, right? You can knock the thing down and build something else on it. Okay, that's going to cost you to do it, but you probably get a high valuation. You can do an extension. You can add a bedroom. You can do all this sort of stuff. You can do a cosmetic renovation, and you might be able to get an uplift of a 20, 30, 40,000 bucks in the eye of the valuer, or if you sell the property. Or you might get a few more bucks in the rent every single week. So same thing applies, but you've just got more available to you in commercial property.
Yeah, and like the common words like repositioning a property. That's what a lot of the big firms, like managed firms, do that. They might buy an office that's a bit down and dirty and needs
From a
revamp.
C grade and they turn into a B plus or something like that.
Spend money on it, fix the walls, just refit it, maybe split it up into multiple tenancies, all that stuff.
You see that happening right now, even at the top end of town, the AMP building. There's 2 AMP buildings. You've got the old one out the front, which is heritage listed. They can't touch the facade. And then there was the one behind it where they completely just stripped the outside of it, stripped it internally, kept the slab, cut it up. And now it's a fancy angled looking thing, which is completely repositioned that property.
Yeah, I think that'll be a big common trend for our CBDs over the next decade.
Thank you, because they've got to get rid of a lot of that 60s, 70s stuff, which is a massive eyesore.
And you might even see them convert to resi. But then again, it's supply demand. Like, is it worth more as a residential, eco-friendly office tower? Like, but maybe offices aren't popular because no one wants to live in the city. So it's
horses for courses.
Exactly.
Horses. It's good, Scott. That's episode 1 of season 2, Inside Commercial Property. Welcome back, everyone. We're pumped for this coming season. There'll be 12 episodes, one every month, running up into 2022. I think we're quite fortunate. Timing is everything in property, and timing is everything in podcast land. To be able to create something when I guess it's counter cyclical, right? We launched this at a time when everyone was thinking property was going to drop, or the resi property was going to drop by 30%, and commercial property, the bottom was falling out of, at least in the office space or that retail space. So we launched the podcast at the right time, I think, when sentiment was down towards commercial property, and fast forward 12 months on, it's a very different proposition today, Scott.
Yeah, and I think it's good. Like, I haven't listened back, but I know back then we were talking about many asset classes were not going to fall through the roof, and a lot of people thought we were silly at the time, but the long-term fundamentals are there, and that even in the office market, everyone thought it was going to drop, but at the end of the day, people are wanting to park their money into assets, and it's about location, and it's the whole residential commentary as well.
Yeah,
where's this 40% crash we've all been told we're going to see for the last 30, 40 years? Like, there's too many levers, and Australia's too property hungry, and it's about sort of the long-term investment, which I think we've covered well.
Yeah, absolutely. And I guess one of the benefits, but also the negatives of podcasts, is that we can't hide from our commentary, right? What we say at any given time, we deem that to be relevant at that particular time. Now, you fast forward a year to where we are today, we can look back at, the first couple of episodes we did on Inside Commercial Property, and did we get the commentary right? I reckon it was pretty considered. We weren't scaremongering or fearmongering at all, and we're not doing that today. If anything, we're probably erring on the side of probably potentially too conservative, telling people don't invest in commercial property because there's not a lot of good stuff out there. Or if you want to invest in commercial property, take your time, be considered, do it the right way. And that's the message that we want. But, we probably should go get some sound bites and some snippets from a couple of those early episodes, Scott, just to see what we're saying. Maybe we're looking at it through rose tinted glasses, rose colored glasses. I can't remember what it is, but thinking that we were spot on, but maybe we got it completely right. Anyway, but this thing's grown into thousands and thousands and thousands of people listening to it every single month. So we must be doing something right, I'd like to think. Well, you are, at least. It's your job to be the brains trust of this outfit. I'm just the guy that tries to steer the chat. But good to be back, mate.
No, thanks for having me, mate.
Season 2. There we are. Remember, any questions at all, you can send them through to Scott at
info at rethinkinvesting.com.
The info at rethinkinvesting.com.au. Remember, go and check out the book. He's selling like hotcakes. I got one of the first copies, I think, signed and everything. So it's on my bookshelf. Yep. And we've done we did a chapter out of it, I think, at some point in time. So maybe we can pick up another bit out of it and we'll break it down and go into it. We want to do some more stuff with some property investors as well. So if you're tuning into this, you want to have a yarn, you can get in touch with us as well. Yeah,
and I was going to say, like, a lot of our clients are very private as well, and rightly so. So if there's any of them listening that want to come on the podcast, just email us. You know how to reach us, and we're happy to sort of talk through your experience and portfolio.
Yeah.
Because it is a very private world, commercial, and a lot of the people I've asked, and I get it, because I remember before I got into this business, I had many properties before I even told my parents.
You didn't want anyone knowing what's going on.
No, and commercial's even more secretive. So if someone's happy to share,
coming in, and I'm happy to sort of demystify or democratise property investment. Look, we talk about money, right? You know, you're brought up as a kid to not ask people about money, right? And I think that is pretty stupid, personally. I think talking about money is healthy because that's how you learn. And I guess I'm in the business of talking about money, so I'm happy to ask anything, whatever. But we're now on YouTube as well, so you can see us, so those people watching it. If you want to come and have a chat with us, we can happy to put a voice thing on you and make a fuzzy, so you can't see you, and we can use fake names, real life things. But if you don't want to use your name, that's okay. But look, you know, come and have a yarn with us. But Scott, really enjoyed it, mate. That's really cool. So that's Inside Commercial Property. Start of season 2. That's episode 1. Check out last season, wherever you listen to this, whatever your podcast player is. And please, one favour that we get a real kick out of, can you please keep those reviews coming, whichever podcast player you're listening to this or on the YouTube. Any feedback, anything you want to say, look, happy. We're big boys. If you've got constructive criticism, leave me alone. Just give Scott a hard time. But we'll be back again next time. Until then, bye-bye.